Okay, so here's a story about how media and Wall Street collude in order to lie to you and play you, the retail investor. And this is a fine example of that. Now, look, right now you're seeing on the screen the Twitter stock over the past 6 months. So, as you know, in April, this was the date on which the deal was announced. And you can see the stock run up, and then you can see the stock run down, and then starting to run up again. So if you don't remember how things played out, basically Elon Musk made an offer to buy the company in April for $44 billion at $54.20. Now, ever since then, Elon got cold feet. He's trying to get out of the deal. There's a whole legal proceeding around it. We are not going to talk about that. But basically, what happens is these sort of deals have a name, and they're called risk arbitrage deals. If anybody is trading right now in Twitter stock, it has nothing to do with fundamentals. The entire behavior of the stock over the past 6 months, as you can see right here, is purely based on what are the percentages that the deal will go through at $54.20. That's the only thing that impacts the share price until the deal gets finalized one way or the other. There's nothing fundamental here. So there's a lot of funds who actually are engaged in these risk arbitrage deals. Because as you noticed, the price of the share, which is $42.20 right now, is significantly lower than the purchase price of Elon Musk's offer. So his offer is $54, current price is $42, which means if the deal actually follows through, people who bought the stock today will get $12 per share in risk arbitrage. Now, those deals are very common, and there's specific funds that actually engage in this. Now, so far, so good. Now, look at this. As you can see right here, the behavior of this chart is basically showing you what the market thinks about the likelihood of a deal. So initially the deal is announced, everybody's euphoric, boom, 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 boom. The stock runs up all the way to $52, almost $52, right on April 25. And then everybody's saying, well, the deal is going to go through, no problem. And even I thought that back in the day. I was like, yeah, the deal is going through, no worries. So the deal actually falls through, and Elon gets cold feet, and then right away you can see the price starts falling because at this point, this arbitrage is going away. It fell all the way, and I want you to remember this number, $32.65. Now, I want you to remember this number because this is really important. This is the number which is going to make everything clear how insanely manipulative these guys are. Now, look, this is the crazy part. $32.65. Can we say $33 just for the simplicity? Let's say $33 just so we keep it simple. So $33 is the bottom of the stock. Now, if you had a time machine and you thought that you could buy the 33 in July 11th and you could sell it right now for $42.20, not a bad deal, right? You buy 32, you sell it 42, a nice little gainer, basically doing nothing, right? But what if you're greedy? What if you say, well, I can probably pump it all the way up to, let's say, $48, $49, back to where it was right here. That's even better, right? Imagine you had the tools to do that. Well, in this video, I'm showing you how somebody could potentially do that, but this is not an allegation. This is all allegedly, in my opinion, might be inaccurate, might be the ramblings of a madman. I'm just speculating on what could have happened. I'm not making any accusations, but I want to show you some crazy coincidence. So this morning, I open up Seeking Alpha, and this is not an indictment against Seeking Alpha, right? But basically, I'm looking at this article. This article is basically saying, hey, there's a high likelihood that the Chancery Court of Delaware is going to rule in Twitter's favor. Basically meaning, this article is saying, hey guys, just so you know, the court is probably going to force Elon to go through with the deal at $54.20, right? Now, if that actually is true, basically what happens is they say, well, look, Tom, the stock is at $42, easy money. So everybody will be pumping into the stock if this was true, right? So I just wonder who's saying that, right? Twitter likely to win court, First Horizon Bank likely to be approved. Investor. Okay, what kind of investor? What investor? Okay, let's look at this. And then you scroll down. Again, this is not an indictment against Seeking Alpha. Every website, Wall Street Journal, Bloomberg, CNBC, they all do the same thing. So basically, they have a guy here who wants to come in and give his expert opinion, which is something they always do. I mean, that's fine. These outlets, they want to get headlines, they want to get experts, and these experts, obviously for no purpose other than to share the information, want to come on. And this is what this guy is saying. Notice they haven't said his name yet. They haven't said where he's working for, nothing. So it starts with Twitter likely to win court battle. It's not a quote. It's basically, just a statement of fact. And then the quote comes. There are very good odds that Twitter wins a trial for a specific performance, and there's also non-zero odds the court awards a very significant monetary damages. Roy Barron, managing member of Westchester Capital and co-portfolio manager of the Merger Fund. Now, basically said it in an interview to Seeking Alpha last week. We think the odds are low that Twitter loses. We think the odds are very low. There's no settlement, no specific performance, and no money damage. Okay, cool. So this expert is coming in here and telling everybody, hey, just so you know, Twitter and Elon Musk will have to go through with the deal, which means that the stock should be priced much higher than $42.20, whatever it is right now, right? So then I'm going to show you something really cool. The Merger Fund, it's a risk arbitrage fund. Basically what they do is they do risk arbitrage deals. They go into these merger situations and they bet on them or against them. Now, here's the crazy part. If you actually go to the institutional ownership of Twitter, here's what you're going to find. Oh my goodness. Look at this. Merck's the Merger Fund. They just bought Twitter shares. Oh my goodness. What a coincidence. So these guys just bought some Twitter shares. In fact, they bought 887,000 Twitter shares at $33,200,000. So these guys just invested $33 million into the Twitter deal. Okay. Now this is a merger arbitrage fund. By the way, notice there's no disclosure here, at least that I can see, that these guys who are giving their expert opinion on what happens with the Twitter deal and Elon Musk have something to benefit from people thinking that the price should be higher, because I'm going to show that in a second. So basically, these guys bought the stock. Now, they reported the purchase on August 25th, but I can tell you exactly when they bought it, and you're going to be shocked. Check this out. So if you divide the $33,200,000 by 887,000 shares, the price per share that you're going to get, I'm going to blow your mind. You know how much? $33. They bought right here, right at the bottom. So these guys come in, buy the Twitter shares right at the bottom, and then articles like this come out. Interesting, right? So if I'm just speculating. I'm not saying that they're doing this on purpose. I'm just speculating. Like, imagine if I had a risk arb deal with Twitter and I would have $33 million riding on Twitter. And I'm already quite high up. Since I bought it at 33, the deal is already at 42. Imagine I want to get it from 42 to 45, just to make a little extra dollars on this deal, right? All I got to do is I got to go to an outlet, to a media outlet, and talk about how the deal is absolutely going through. There's no way the deal is not going to go through. The stock may or may not react, but if it does, boom chakalaka, free money. Now, this is, in my opinion, at least morally flawed. I'm not sure about the legalities of this, especially if there's no disclosure here on this article about them actually benefiting. Because when they say these things, well, there's no chance Elon isn't going to do the deal. They're trying to, improve their own stock position, which is weird to me. There's no disclosure that I can see. That's so crazy. There's no disclosure. Oh my goodness. So basically this is how it works. If you have the clout money, if you're a fund and you're trying to do a risk arb deal, you can sweeten the deal. Go on mainstream media, talk about how the deal is going to go through. They'll put it out there because you're an expert, you're a hedge fund, right? And then when the price pumps a little bit higher, let's say to, 44, 45, then you sell. And you made nice gains. And no harm, no foul. The only problem is that investing, and especially trading, is a zero-sum game. So just make sure you understand what's happening here. When they win, by definition, somebody loses. And 99% of the times, it's the retail investor left on the other side of this trade. So be careful before you read mainstream media and whatever nonsense they're telling you about any sort of risk arbitrage deals.